Good evening, all the joinees. Thank you so much for joining in. Hi, this is Prajakta. I would like to warmly welcome you all on behalf of NGEN Research. Meanwhile, others join. What we will really do is introduce our topic for today's webinar. Our topic for the today's session is going to predominantly revolve around overview of Indian equity markets and understanding what are the sectoral performances across different sectors of typically Indian markets. In addition to that, what we will really do is we'll compare the correlation analysis of different sectors belonging to Nifty, or for that matter, NSE basically, or BSE, and actually check how do they correlate with each other. What we will really do by understanding the correlation analysis is have understanding as to what is the directional movement and how coordinated are the movements of of a pair of sectors. Okay. After that, we will have a look at the sectoral performances using a point-to-point analysis, wherein we will compare in different scenarios what have been the performances of varied sectors of BSE as well as NSE. After that, we will have a look at risk and return scatter plot in the compare section and have a look as to what were the risk and return parameters of each of these sectors across different time periods. Lastly, we will have a look at the drawdown analysis, which helps us in understanding the strength of each of the sectors, for that matter, or any security, to recover from a drawdown and actually show resilience to the volatile movements or volatile direction in the markets, right? Finally, towards the end, we will throw the forum open for a Q&A session wherein you can get your questions answered by either typing it in the chat box or unmuting yourself to speak. Let us now begin. So typically for discussion today, we will be predominantly focusing on two sections on NGEN Markets. First is the market section, and second, of course, is going to be the compare section. Okay, this, of course, as you know, is the landing page of NGEN Markets. The moment you come or log in on NGEN Markets, you will see the market section, which is really displayed. Okay, once you come here, now today we are going to really compare Indian markets or broad-based markets with, let's say, a foreign index, or for that matter, other major equity indices of other countries, right? So for that, what you will really do is we can typically simple mouse click on one of the indices. So let's say we want to compare a Nifty 50 across a time period. So what I do is I just click on this market level and this will get plotted in the form of this line chart. Now, I can specify the time period that I want to do this analysis for. Of course, I can put in the start date. The end date, of course, will be set at the current available prices. So typically we have yesterday's closing prices. And that is typically there in the as the closing prices. So 6th of October, and that's the rebased price, right? Typically, if you untick rebase, you will get the current levels, right? It's 19,653, and that's the level that you can see right here. Typically, the rebase option is used for using a fair comparison or making a fair comparison across different indices. Typically, now let me add let's say a mid cap, Nifty mid cap 100, right? The moment I do that, I click on it, it will get plotted in this line chart, and I can see Nifty mid cap is around 40,000, right? And Nifty 50 is around 19,600. Right, but you will see the levels are so different. That's the reason the line charts will start from very different levels, which will not make a fair comparison between these two levels possible. And that's the reason we've given a rebase option. The moment you click on rebase, what it will really do is it will take these two market indices to common start point of 100, and then we will be able to map its performance across different time periods. Of course, in this case, we've considered a year-to-date scenario, which is starting from 2nd of January 2023, right? Now I will just click on rebase. What has really changed is the start level of these two indices are now starting from a common start point of 100. Okay, now you see that from 2nd of January 2023, Nifty 50 has given a 8% return. Nifty Mid Cap 100 has given a 26% return. Okay, so that's clear outperformance by a mid cap index over a Nifty 50. Right? Let's say now you want to change the start date and you want to, typically do this analysis for the past 5 years. All you need to do is go on the start date tab right here and put in the start date of your choice from this drop down option. So let's say 2018. Again, let's do this analysis for the past 5 years. So October of 2018, we're already into the second half of the financial year. So typically 1st of October 2018 onwards, if I really check, so mid cap is still outperformed, Nifty, which is a large cap index, and the crossover is happening right here, right? Till basically in 2020 as a calendar year, Nifty 50 actually was at the top, right? Mid cap was consistently down here. As you can see, the black line is below the blue line, which tells you that there was some amount of underperformance by this particular benchmark. But after that, you can clearly see this crossover happening. Typically from 2021, we have seen mid cap really outperforming Nifty 50. And that's clearly visible even here. Now, let's go ahead and add some other, indices. Let's say add a small cap. The moment I click on it, it will get added as a different color coded line chart, which in this case is a green color coded line chart for Nifty small cap 100, right? And its performance, of course, as you can see, is 108% if we consider cumulative performance from 1st of October 2018. Okay, this is the absolute cumulative performance of Nifty, Nifty mid cap, Nifty 50, Nifty mid cap 100, and Nifty small cap 100. Okay, now in addition to this, let's say you want to compare this against a Dow Jones or maybe a NASDAQ, right? Then what can you really do is just scroll at the bottom, and we have listed major world equity indices right here. All you need to do is just click on this and it will get plotted in the form of a line chart. So let's now consider a Dow Jones, maybe a FTSE 100 as well. So that's typically US markets and the UK markets. So what we've really done is we've added them here. And you can see FTSE 100, in fact, has given a negative 0.31% performance in the last 5 years, if we were to consider cumulative basis. On the other hand, a Dow Jones has given about 23% return, and that's clearly visible right here. Now you can also make this scenario a little bit shorter, meaning to say, let's say we want to check the performance of these schemes, these indices typically post COVID. Then what you can typically do is change the start date and seamlessly take this as a post COVID scenario. So maybe starting from 1st of May. Right. The moment you change the start date, you will see this performances change again. And in this case, you can see the outperformer among the lot is small cap 100, right? It's visible right there. The small cap graph, which is indicated by the black line over here, is at 214% out performance of this particular index in the last 3.5 years, right? That is how you can compare Indian markets with any of the indices that you can see here. Of course, here we've compared it with global indices as well as mid cap and small cap sub indices, right? Typically, you can add in any sectoral indices as well. But for comparing sectoral performance, let's go to the compare section, wherein we will get to know what were the Sharpe ratios of each of these markets, indices, typically, what were its correlations. So typically, we will head over to the compare section and further analyze sectoral performances of, Indian markets right there. So for that, let's again go to the compare section. The moment we go to the compare section, you will see this screen blank right here. What you can do is you can go ahead and add these sectoral indices one by one using this search indices option. So typically for mutual funds, what you do is you add a security from here, add a fund. For sectoral benchmarks, or sectoral indices, you add it from here. So let's say I want to add in a pharma. So just search for a pharma, you add it here, it has gotten added. Now let me compare this with a Nifty IT. And maybe a Nifty 100, right? The moment you add these three, now the performances that you can see right here are the performances of each of these indices since the respective indexes inception date. Okay, so for an example, pharma has given a CAGR of a 12.63% from its inception. Nifty 100, on the other hand, is given about 15.34%. Nifty IT has given about negative 1.38. Typically, to say if we change the start date and actually check this, so let's say, for an example, you want to do this analysis again for the past 2 years, let's say. So 2021, you choose 1st of October and you click on go. You can typically see that the outperformer among this lot was a Nifty 100, which has given a CAGR of a 4.90. On the other hand, Nifty Pharma is about 1.82%. On the other hand, Nifty IT is about negative 3.53. Right, that's typically the performance that we can see right here. Of course, here as you can see, the start date that we have really put here is 1st October 2021. All of this data is from 1st of October 2021. That is how you can use this typical column and put in a start date to run an analysis from. Now, let's consider what were the volatilities or the standard deviations of each of these indices over this particular time period. If we consider last 2 years, we can see the highest volatile index was Nifty IT with a volatility or a standard deviation of a 21.56%. As opposed to that, a Nifty 100 was at around 14.44, and a slight bit of a higher volatility was recorded by a Nifty Pharma with a 14.89%, right? That's the standard deviation, which is a measure of volatility or the risk that is inbuilt in each of these indices. Now, of course, here we've considered only 3. What you can typically do is you can add in as many indices as you want and make a list and save it for your reference. So for an example, how will you do that? You can just go on and adding as many items or as many sectoral indices here and actually make a list out of it. So let's say we want to save a list of these 3. All I will do is go to save this list. I will name this as, okay, this is my October watch list. And I'll click on save. The moment I do that, this list will get saved in this My List tab. Now, even if I remove all of these items, the next time I want to refer back to them, I don't have to add each of these again. I can simply click on My List, and the list that I would have saved, that would appear right here. So we named it as October watch list, which has 3 items. The moment I click on it, these 3 items will get loaded. Okay, that's how you can actually save lists. So, for the purpose of our discussion today, I've made a list of NSE indices. I've considered about 8 of them. So let's load that up. Again, I click on My List. I scroll down and find that particular list that was created. So it was named as NSE indices. I click on it and the entire list has gotten loaded right here. So we are comparing pharma, bank, Nifty, FMCG, Nifty 50, IT, auto, and infrastructure, right? These are the sectoral indices that we are comparing. Now, let's understand what are their correlations among each other, meaning how similar would be the directional movements of Nifty and how will they get affected by the movements in other sectoral indices. For that, the go-to tab is going to be the correlations tab, wherein we will understand how do they correlate with each other. So for an example, Nifty Bank has a correlation of a 0.42 with a Nifty IT, right? Meaning if Nifty Bank goes up, 42% of the times Nifty IT will also go up. That, mind you, is not a very, very strong correlation. Typically, the correlation figures range between -1 to a +1. The more the number is closer to a +1, that means stronger the correlation between the 2 indices. right? So in this case, it is just about 42%, which is not very, very strong. Typically, on the other hand, we can see a Nifty bank has a pretty strong correlation with the Nifty 50. The two are correlated to an extent of 0.87, meaning to say close to 87%, right? Meaning if Nifty bank is going up, Nifty 50 is going up 87% of the times, right? These are calculated considering the daily movements in these indices over a start date that is really mentioned here. So this is from 1st of Jan 2004. That's the youngest date that we have for the sectorals, that we have. So typically, if you see this, Nifty Auto is the youngest among the lot, which would have launched from 1st of Jan 2004. And that is why this correlation analysis is running from this particular date. Right? This is a matrix structure. The way to read this as is hover on a particular cell, right? The moment you hover on that particular cell, you will know the correlation of that particular row with the column heading that appears at the top, right? So in this case, we are looking at a correlation between Nifty bank Nifty, and infrastructure sector, right? Which is a correlation of about 79.79, which is fairly strong correlation. And that's what this heat map will serve you, right? The moment it will cross 0.50 and up, it will be, color coded into greens, right? Typically, if it is negative, it will be color coded into reds, right? This would be more relatable if you're actually seeing the correlation of an equity fund with, let's say, a debt fund. You will see the correlation is either very, very low or in fact at times negative also, right? That is how you can actually make sense of this, and you can understand the diversification benefit that the client might get by incorporating mutual funds belonging to these sectors in the portfolio, right? Of course, this is given that they actually follow the correlations of their respective sectors. Only in that case, these correlations, and if you build a portfolio using this correlation matrix, it will actually give result into a diversification which will match the diversification metrics of these sectoral indices, right? That's about the correlation analysis. After that, what we can also have a look at is risk versus return scatter plot. In this case, we'll have to go to the risk versus return tab, which is mentioned right here. And we can check what were the risk and return parameters or risk and return statistics of each of these sectors across different scenarios or different time periods. So for an example, let's build a scenario of 6-8 months of the last general elections, right? So 2019, let's consider January of 2019, and let's see how were the risk and return metrics of each of these sectors in that time. So I'll just put in a start date as 2019, 1st of January, and the end date could be 31st of July 2019. So that's about a 7-month period that we are considering. And you click on go. The moment you put in the start dates, you just click on go, and it will take into effect the period under consideration. So for an example, how will you so let's first understand how will you read this. So this is a risk and return scatter plot. You will see the entire graph being divided into 4 different quadrants. The first quadrant is low risk, high return. The second quadrant is low risk, low return. The third quadrant is high risk and low return. And the fourth quadrant is high risk, high return. Now, on the x-axis, what we are really mapping is the standard deviation or the annualized risk of each of these sectoral indices. Okay, that means if a particular sector gets plotted on the right-hand side, it is higher risky, right, than the one than the sector that has gotten plotted on the left hand side of this x-axis, right? For an example, Nifty FMCG is lesser risky than a Nifty infrastructure, than a Nifty pharma, than a Nifty auto, right? Because it typically falls on the left hand side. Nifty FMCG is on the left hand side, and Nifty auto, for that matter, is on the extreme right hand side, right? So Nifty auto in this case is the highest risky sector, of course, in this time period. That's the 7-month time period that is under consideration, right? Now, on the y-axis, we have annualized return, right? Typically, the more the fund, or for that matter sector, gets plotted on the higher end or the top end of this particular y-axis, it generates better return. On the other hand, if it gets plotted in the lower quadrant, or meaning to say on the lower side of this particular y-axis, it has generated a lesser amount of return, right? For an example, if we were to check just pharma, Nifty Pharma, just focus on the return numbers. In this case, we can see Nifty Pharma has a return of negative 19.13, right? Just focus on the returns, ignore the risk for an example sake right now, right? Return is negative 19.13. On the other hand, a return of a Nifty IT is 13.22, right? So Nifty IT has gotten plotted above Nifty Pharma, and that's typically the reason that its return is typically higher than Nifty Pharma's return. And that's how you read this particular graph, right? Risk and return plot. Now let's try to analyze or interpret these results for all of us, right? So we can see the risk and return matrix of Nifty 50 in this time period of close to 7 months is with a risk or volatility of a 12%. It generated an absolute return of about a 3.52%, right? Now, with typically the same amount of risk or similar amount of risk, what were the returns of FMCG? FMCG, of course, it has a lower return, and that is to say that's because Nifty FMCG has gotten plotted on the left-hand side of Nifty 50, right? And of course, lower also. So you can see that the return is negative 8.33. On the other hand, the risk is 11.40, which is of course lesser risk as compared to Nifty 50, right? And that's the reason it is on the left-hand side of this particular line chart. On the other hand, the best performing sector in this particular time period was Nifty IT, which gave in a return of a 13.22 with a risk of 14% or a volatility of a 14%. On the other hand, the worst performing sector in this entire time period was definitely a Nifty Auto. It not just had the highest risk, but it also recorded the lowest return. In fact, the return was as low as a negative 50% in this particular sector, right? And that is exactly what is highlighted here. Right? We can also actually corroborate this fact if we go to scenario analysis using this point to point. Let's just do that for the time being. So let's just quickly jump to point analysis, and in any of these buckets, let's just put in the dates that we were considering. So in this case, what we were really considering is 1st of January 19 to 31st of July, and that's the exact dates that I've put in here in the second last bucket right here, right? Let's check this in absolute terms. The moment I click on absolute, I can see this particular periods. So in this case, I can see the worst performing was a Nifty Auto with the highest negative return of a negative 25.38. On the other hand, the best performing sector was a Nifty IT, which is with a return of the highest extent, right? 8.09% return, which is the highest return in this particular time period. That is how you can use this risk versus return scatter plot and point to point to actually corroborate all of this and actually create multiple scenarios. Like how we've created an election scenario of course 2019, you can create something like a 10-year scenario, right? For that matter, let's just put in a 10-year scenario in any of these buckets. These are available to actually explore different scenarios. But let's consider a 10-year scenario, so 2013 onwards, October 1st. And let's consider an end date of again October 1st, 2023. Right. So this is a 10-year scenario. And of course, because it's a 10-year scenario, if we click check absolute returns, it will give us a cumulative return for the entire 10-year period. Now, if I click on sort, I can see that Nifty Bank was the outperformer of the entire lot. It gave in 351% return. Right. On the other hand, Nifty IT was the close second with a 288% return absolute basis for the entire 10-year period. Okay. Now, on the other hand, Pharma was the worst performer among the entire lot. If we consider this 10-year period, which is just a return of 108% over the last 10 years. right? That's just about 10% annualized return. Right now, we can see this in contrast if we build a post-COVID scenario. Typically, the calendar year of 2020 and 2021, right, where we will see that okay, pharma has actually outperformed the entire lot. This is the calendar year 2020 that I've considered. I click on sort, I can see Nifty Pharma outperforming the entire lot. Right, this is how typically you can build in many scenarios and actually side by side compare the performances and the cyclical nature of each of these sectors across different time periods. And of course, once you put in these dates, these will be saved unless and until you change them. And that's exactly what is highlighted here. Dates will be saved unless and until you change it. Right. So this is the 10-year analysis, this is the COVID year analysis. This was the election scenario that we just built. Right. You can use these any of the 5 buckets and build scenarios of your choice. That's how you can check point-to-point analysis. Of course, the option to check it between annualized percentage or absolute percentage can be really used by using this toggle button. Right. Let's say it is getting a little bit difficult for the client to understand all of this in percentage terms, and that, we've given a lump sum investment value example as well. So for an example, you can typically say that if 10 lakh were invested, right, on 1st of October 2013 in let's say in pharma, right, it would have 10 lakh would have become 20 lakh 89,000. On the other hand, Nifty Bank, it would have become 45 lakh rupees, right? The option to toggle between amount terms or percentage terms will always be there in the point-to-point analysis tab. Okay. After that, let's quickly move to a years tab, which is again fairly simple. But in this case, these are standardized years that we have really given. Let's say you do not want to build a typical different various scenarios, but you want to do a standardized analysis across calendar years. Then what you can do is simply click on years as a tab. This is fairly straightforward. These are calendar years. And let's say you want to check in, let's say 2020, right? Just sort it. You can see the best performing sector, the worst performing sector. Right, you can check in any time periods for that matter. Let's say year to date scenario, right? So 2023, the best performing sector as yet in this year seems to be auto, right? 26% return. And the worst performing, of course, is the bank, which is 3.20% return only in the last close to 9 odd months, right? We are in October, so 9 odd months. Right, that's the calendar year analysis. Now let's move ahead to the last part of the webinar, wherein we'll discuss the drawdowns analysis and understand the significance of drawdowns in understanding the resilience of a sector, or for that matter, any fund, to recover from a loss. Right, for that, let's click on drawdowns. And this typically tells us what were the worst drawdowns that were experienced by the sectors and how much time did they take to recover the entire loss. So let's consider a time period of 5 years. So 2018. Let's say September or October for that matter. And if I start the entire drawdown analysis from 1st of October 2018, what I can really interpret from this is if I really consider periods from 2018 of October, the worst drawdown or the worst loss was reported by Nifty Auto as a sector, which was the loss of a highest magnitude of close to 50%. Right? And this happened over a time period of close to 2 years. Right, 1st of October 2018 to 3rd of April 2020. Nifty Auto as a sector fell 53%. After falling so much, the sector took 200 working days to recover this loss in entirety. This entire loss of 53% was completely recovered in the next 200 working days. And that typically happened on 8th of Jan 2021. And that's exactly what we are seeing when we click on this line chart. Okay, so in this case, we are considering Nifty Auto. Its worst loss was of 53% when the index level was around 9,600, right? After that, it fell to a 4,500 level, right? That's exactly a loss of 53%, right? After that, the level or the index took 200 working days to go back to the same level of 9,600. And that can even be corroborated by hovering on the white portions that you can see here, because these gray areas will signify the drawdown or the loss periods, and the white areas will indicate the recovery periods. You can see this steep drawdown is typically indicating the first worst drawdown. And the moment I try and hover on 2021, typically Jan, let me try and hover somewhere here. Yeah, so I can see that the level has gone well past 9,600 level, which is on 27th Jan, it is around 10,200, right? And that is exactly why we've called 8th of Jan as a recovery date, when it recovered its entire loss, right? And of course, this is the worst drawdown. This is the second worst drawdown, which is of a magnitude of a 21%, when the index fell from 12,000 to a 9,000, right? And after that, again, the index took 88 days to recover this entire loss and go back on the growth trajectory. Currently, the level is around 15,900. Right? Now, the purpose of this is you can actually sort it on the basis of the best recovery, right? So each of these sectors, as you can see, have recorded losses of varying magnitudes. But if we were to see that pharma has recovered its entire loss within 53 working days, right? Its worst loss, it is recovered in 53 working days, right? On the other hand, the most sluggish sector to actually recover its loss was a Nifty Bank, which took more than 200 days to actually recover its entire loss, right? And ultimately it got recovered, and that happened after 212 working days. Okay, this is how you can use this drawdowns analysis to understand what is the strength of a sector to recover from its worst loss, right? That's typically it from my side about this webinar. We can now throw the forum open for a Q&A session, where you can type in your questions in the chat box or unmute yourself to speak. Thank you. So there's a question in the chat box which says, please add Nifty 100 in the market level. So typically, the process is simple. You go to the main list, you go to search indices, and you add a Nifty 100. Locate it, click on it, it will get added in the compare section. You can now see Nifty 100 is right there. And now the stock, the sectors that we are considering are 8, right? There's another question in the chat box which says, can we also compare two mutual fund schemes similarly or more? Absolutely. Typically, today we were discussing how we can compare sectors, but definitely all of this applies for mutual fund schemes also. All of these analysis will be equally applicable for mutual fund schemes as well. So let me quickly load in a list of mutual fund schemes. I'm loading in some random mutual funds. So this is a list of close to 6 funds, right? And you can perform the same analysis. Of course, this is a very diverse set that we have. Let's say we want to check its drawdowns, right? Go to drawdowns analysis, and we can see that in this lot, if we start the analysis from 2013, the worst loss, or the loss of the highest magnitude, was reported by a iPro multi-cap fund, which had a loss of a size of 38%. And after that, it recovered its entire loss in 181 working days. Now, if you were to dive a little bit deeper in this recovery chart, just click on this chart icon, and you can see that this 38% loss happened when the NAV of the fund fell from 327 rupees to 199 rupees, right? And after that, the fund took 181 days to recover this entire loss. You can also sort them on the basis of their recovery periods, and you can check this analysis on a single fund or a set of funds as well. You can also, in fact, compare funds with a benchmark, right? Typically, if we were to, load in, let's say, small caps, right? We've loaded in small caps, and you would like to check how do these small cap funds, really perform against their benchmark, which is Nifty small cap 250 for that matter, right? So you can do that as well. So I've added in a benchmark and a set of small cap funds. And let's say I want to check its drawdowns. I can definitely do that. There's another question in the chat box which says, is there any tool to track alpha? Yes, of course. So we have annual excess as a term that we typically use to check what are the excess returns that are generated by each of these funds over their benchmark. But of course, when it comes to alpha, you will have to compare it with a benchmark to actually calculate alpha or excess return, right? And that as a measure, or in the pink columns, it will appear only if you put in a column or a benchmark right here. So let's say you want to check alpha or excess return over a benchmark for each of these funds. What you can do is you will have to add in the benchmark here as well. So Nifty small cap 250. The moment I do that, the data will come up here, and the annual excess tells us whether the fund has actually outperformed the benchmark or not with respect to its returns, right? In this case, Aditya Birla Sun Life Small Cap Fund seems to have underperformed the benchmark. By that, we mean to say that it has not generated a positive excess over the benchmark. On the other hand, all the other funds have actually managed to generate a positive alpha, right? Or a positive excess over benchmark. In this case, SBI small cap being the best performer, which has generated the highest alpha over the benchmark. Okay, there's a question in the chat box which says, I'm asking for respective benchmark. Okay, so let's say, do you mean like, okay, if you want to check for SBI small cap as a fund, and its benchmark is, let's say, this particular index, which is, this, and then you want to check its, alpha or its potential to generate excess return over its benchmark, then you can load in the fund in a new tab, and you can check whether it generates a alpha over the benchmark or not. So that's definitely there. So we have this another question which says, so we have total 161 indices. You can definitely choose from them to actually compare across varying sectors. We are actually working on adding as many more indices as possible, but typically Nifty 50 value 20 we have, right? So you can typically check that. There's one more which says Nifty momentum. I'll have to check. Yeah, so we do have Nifty 200 momentum 30. If that is something that you would like to check, that's also possible. There's another question in the chat box which says, can we compare performance of a portfolio with a gold return? So typically for commodities, what you can do is you can download the time series and price series of gold, right? And save it as a security in the My Securities tab. Once you have it in the My Security, you can load, gold. So this is the gold example that I've actually saved. These are gold prices for the 7 years, and I've saved it as a security. By actually downloading the prices from NCX, right? Once you have it here, As a security, you can typically compare its performance against a Nifty 50, right? How did it measure up against Nifty, or maybe for the example, let's say Nifty 100, right? You can check its performance against Nifty 100, which is a benchmark. Alternatively, let's say you want to check its performance against a mutual fund, right? So what you can do is go to the compare section. Let's just remove everything else, and let's just keep one fund, and actually compare its performance against gold, right? This is gold 7-year prices. I've added those two, and I can see the returns of these two funds, right? One fund and one commodity. The CAGR of gold is about 13%, of course, in the time period that we've considered, and mutual fund is about 16%. Of course, these time series and price series for anything that is non-standard, like a commodity or a foreign stock, all of these you'll have to provide the system with the data, right? So in this case, gold 7-year prices, I had saved the security with the time series until 28th of June 2023, right? So starting, of course, from 28th of June 2016. So this is the period that I would saved it for 7 years. So you can typically save it and then compare it in the compare section. Okay, so we seem to have answered all the questions. So thank you, everyone, for joining in. You can definitely check out our webinar recordings on our YouTube channel. So for that, you can simply go on this YouTube tab, and you can definitely see there's a dedicated playlist for all the webinar videos. You can find those in the playlist right here. 83 videos already uploaded. You can definitely check these recordings and stay abreast with the topics that we are covering. We'll definitely come up with a new and exciting topic next week. So do stay tuned and have a great weekend ahead. Thank you.